This video will overview of what going public means for a company, understanding SEC registration and reporting requirements for U.S. companies. Remember to subscribe and share. The decision to transition from a privately held entity to a publicly traded company represents one of the most significant milestones in corporate development. Going public, typically achieved through an initial public offering, IPO, provides companies with access to capital markets, enhanced liquidity for shareholders, and increased visibility in the marketplace. However, this transformation brings substantial regulatory responsibilities that fundamentally alter how organizations operate and communicate with stakeholders. The Securities and Exchange Commission, SEC, serves as the primary regulatory authority overseeing public securities offerings and establishing the framework for corporate disclosure in the United States. The initial public offering process. An initial public offering refers to the process by which a company sells shares of stock to the public for the first time, typically to raise additional capital for business expansion, debt reduction, or other corporate purposes. U.S. Securities and Exchange Commission 2024A. This process is governed primarily by the Securities Act of 1933, which requires companies to file comprehensive registration statements before offering securities for sale to the public. The registration statement serves as the foundational document providing investors with material information necessary to make informed investment decisions. The Form S-1 registration statement constitutes the primary disclosure document for domestic companies conducting their initial public offerings. According to the SEC, this form requires extensive financial and business-related disclosures, including company history, organizational structure, executive compensation, subsidiaries, and audited financial statements. Ernst & Young, 2024. The registration process begins with an organizational meeting where the company, its legal counsel, underwriters, and auditors coordinate responsibilities and establish timelines for completion. Once submitted, the SEC staff reviews the registration statement to determine compliance with disclosure requirements. The Commission does not evaluate the investment merit of securities offerings. Rather, it assesses the appropriateness and completeness of the disclosure provided. Deloitte, 2025. Companies typically receive initial comments from SEC staff within 27 calendar days, after which they must respond and submit amended registration statements reflecting the requested changes. The registration statement becomes effective only after SEC staff approval, at which point the company may legally sell the securities described therein. Ongoing reporting obligations. Following the effectiveness of an IPO registration statement, companies become subject to the continuous disclosure requirements established under the Securities Exchange Act of 1934. These obligations ensure that investors maintain access to current and accurate information about the company's financial condition and business operations throughout its existence as a public entity. Annual reports on Form 10-K. The Form 10-K serves as the comprehensive annual report required by SEC rules, providing a detailed overview of the company's business and financial condition, U.S. Securities and Exchange Commission, 2021. This document includes audited financial statements prepared in accordance with generally accepted accounting principles, GAAP, management's discussion and analysis of financial condition and results of operations, descriptions of business operations and risk factors, and information about executive compensation and corporate governance. Large accelerated filers must submit their Form 10-K within 60 days after the fiscal year end, while smaller reporting companies have 90 days to comply with this requirement. Quarterly reports on Form 10-Q. Form 10-Q provides interim financial information for each of the first 3 quarters of the fiscal year, as the fourth quarter's information is incorporated into the annual Form 10-K. Top and Merrill, 2025. While similar in content to the annual report, quarterly reports contain less detailed information and include unaudited financial statements. These reports enable investors to monitor company performance throughout the year and identify emerging trends or concerns before annual reporting periods. Current reports on Form 8-K. The Form 8-K mechanism allows companies to report specified material events as they occur, typically within 4 business days of the triggering event. U.S. Securities and Exchange Commission 2024B. Events requiring Form 8K disclosure include entry into or termination of material agreements, completion of significant acquisitions or dispositions, changes in executive leadership or the board of directors, bankruptcy filings, and amendments to the company's articles of incorporation or bylaws. This reporting mechanism ensures investors receive timely notification of developments that may affect their investment decisions. Sarbanes-Oxley Act requirements. The Sarbanes-Oxley Act of 2002, SOX, fundamentally transformed corporate governance and financial reporting standards for public companies in response to major accounting scandals at corporations, including Enron, WorldCom, and Tyco International. This legislation established enhanced requirements for executive certification of financial reports, internal control evaluation, and auditor independence. Audit Board, 2025. Section 302 of the Sarbanes-Oxley Act requires chief executive officers and chief financial officers to personally certify the accuracy and completeness of quarterly and annual financial reports. These certifications attest that the signing officers have reviewed the reports, that the reports contain no material misstatements or omissions, and that the financial statements fairly present the company's financial condition and results of operations. Executives who knowingly certify non-compliant reports face penalties including fines up to $1 million and imprisonment for up to 10 years. Section 404 addresses internal control over financial reporting, ICFR, requiring management to assess and report on the effectiveness of the company's internal controls, with external auditor attestation for larger public companies. According to IBM, 2025, a majority of organizations report that the scope of SOX compliance has significantly expanded over recent years, with many companies spending more than $1 million annually on compliance efforts. Despite these costs, effective internal controls provide substantial benefits by reducing the risk of financial misstatements, enhancing data security, and improving overall corporate governance. The regulatory framework governing public company disclosure in the United States represents a comprehensive system designed to protect investors while facilitating capital formation. Companies contemplating an initial public offering must carefully evaluate their readiness to meet the extensive registration requirements under the Securities Act and the ongoing reporting obligations mandated by the Securities Exchange Act and the Sarbanes-Oxley Act. While compliance with these requirements demands significant resources and organizational commitment, the benefits of public market access, including enhanced capital availability, shareholder liquidity, and corporate credibility, continue to attract companies seeking growth opportunities in the public markets. Understanding these regulatory mechanisms remains essential for corporate leaders, investors, and financial professionals navigating the complex landscape of U.S. securities regulation. Thank you for watching. Remember to subscribe and share.